You need to make a huge presentation in an hour. Luckily, Adobe Acrobat Studio uses AI to take all your documents and generate a presentation with a single click, building slides faster than ever before. So if you need a last-minute pitch deck, do that with Acrobat. Need to level up your presentation design? Do that with Acrobat. You have 30-plus documents that need to be simplified into a proposal? Do that with Acrobat. Learn more at adobe.com/do-that-with-Acrobat.
With Volley from iShares, you get access to both monthly income and growth potential in one simple ETF. It's the best of both worlds. Discover Volley, iShares Large Cap Premium Income Active ETF. iShares, the market is yours. Visit www.ishares.com to view a prospectus for investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Risks include principal loss and the use of derivatives, which could increase risks and volatility. Monthly income is not guaranteed. Prepared by BlackRock Investments, LLC.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/stories.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Today, my co-host is Michael Casper, senior U.S. equity strategist at Bloomberg Intelligence. Mike, thanks for joining me today.
Thanks, David.
So you put out a Bloomberg note earlier this week on the market pulse gauge for January. For listeners who haven't seen it yet, can you briefly explain what the gauge tracks and what it told us about small cap performance last month?
Yeah, so the market pulse gauge is a 6-factor model trying to assess risk-taking within equity markets broadly. So we look at the whole Russell 3000 forward returns when we're talking about this thing. And what it's been saying for the last several months, it's been flittering in and out of what we call a manic condition, right? So overheated risk-taking. And typically when you're in a manic condition, defensive sectors tend to do a little bit better than cyclical sectors. Overall, Russell 3000 forward returns are a bit slower than average. Not necessarily negative, but slower than average. It's very difficult to call tops. And small caps tend to do a little bit worse than large caps, kind of on the edges there. Conversely, when you get a panic condition, which is when risk-taking is totally washed out, small caps tend to do better, cyclicals over defensive, that type of thing. And what we hit at the end of January was an official manic condition. So as these repeat manic readings, this gauge is updated monthly, as these manic readings repeat, that's a signal that the manic signal is getting stronger. Tops, again, take a long time to form in markets. You need a lot of risk tolerance to build to get to those tops. And we started to see evidence of that in January. We had a repeat reading from January to December. So it is signaling that stocks are a little bit due for consolidation. We've started to get quite a bit of that in February. Overall, though, I'll say, I do think it's more of a consolidation than a broad correction in the market. Earnings expectations are still very robust for the S&P 500. For the Russell 2000, we're recovering out of a years-long, pretty much, revenue recession and earnings recession. And consensus estimates are holding up quite well, and the earnings season actually has been coming in a little bit better than expected. So I think overall we're looking at still a favorable backdrop for stocks, just a little bit of turbulence in the signal right now.
Okay. Well, it'll be interesting to watch how that plays out this month. And, our discussion today is going to be going smaller than small caps. So we're going to be discussing microcaps. So I think now, I should say, is a great time to bring our guest on. Christopher Tessin is founder and managing partner of Acuitas Investments and serves as the lead portfolio manager for their small and microcap portfolios, including the Acuitas US Microcap Fund, ticker AFMCX. Thanks for joining us, Chris.
Yeah, thanks for having me.
So let's start at a high level. How would you describe the Acuitas investment process and, what makes it distinct from other microcap approaches?
Yeah, I think Acuitas is distinct in a couple of ways. First of all, it's multi-manager, and so I think investors are probably less um, knowledgeable about that discipline. That basically means that we're evaluating investment managers for purpose of allocating and putting them together in portfolios for the end clients, trying to find complementary managers to deliver strong returns for our end clients. So that means that a lot of our work is evaluating investment managers, not evaluating securities. And we do it uniquely down in the small and microcap space. So we have products globally, but we're unique in a sense that as a multi-manager, we only look at small and microcap. We really only look at the areas where we think there's the highest potential for excess return in the markets.
Great. So, you did kind of touch upon the multi-manager structure. Can you walk us through the process of selecting, sizing, or, monitoring sub-advisors? What has to be true before someone earns the capital?
Yeah. As far as evaluating managers, it really begins with idea generation. The idea generation process is paramount. So that means lots of digging, lots of meetings, lots of, once had a consultant ask us, well, how do you get comfortable with an investment manager in just, an hour long meeting? And we're like, the hour long meeting is the handshake. That's the, that's the introduction. That's where you just get started. It really has to be a deep understanding of the process and philosophy of the underlying managers, trying to evaluate whether they have skill. And that's a challenging thing because your first order is often just going to returns and seeing how have they been. Um, but you really have to put those in context. Were they, heavy in tech in 1999? So, does that mean they were a great manager or were they, being rewarded for their exposures at the time? So we spend a lot of time digging in fundamentally to the manager and their process and philosophy. And we've done this for decades. We have analysts and portfolio managers here that have specialized in evaluating investment managers. We have a history from another larger firm where we did this. And then in the end, we're trying to put those, complementary managers together for clients to add value. But a lot of time, spent on the idea generation process is paramount. And we can talk more about that if you like, about where we find them. But that's where it begins.
And how do you approach different investing styles and selecting managers to represent maybe the best of value and growth?
Yeah, and it's a good question. We actually look at all styles. Managers often have an idea of their discipline and where they fit. Um, but for inclusion into a portfolio, we'll actually determine, we'll create our own vision of where they fit. So a manager in the growth spectrum, there are just many flavors of growth, as you know, many sub styles. So, there's aggressive growth, momentum growth, quality growth. There's all sorts of, and different managers evaluate different characteristics. There are lots of ways to win and be successful, but we're really trying to find the managers that are truly exceptional stock pickers and can add value over time. And that's a challenging thing because in every sub-style, there are certain characteristics that usually managers are better at in order to win. For example, in the very aggressive growth managers, they tend to be dealing in higher PE stocks. So that means there are bigger car crashes, right? When stocks don't work or a CFO leaves or something like that. So you need a really strong sell discipline. So if we're in and talking to an investment manager, we're spending a lot of time with an aggressive growth manager about their sell discipline. And we'll go through many, many names. We'll go through examples and the current portfolio and all those things about what worked and what didn't work to try and just evaluate their skill in that space. But overall, we're generally delivering core products to the end client. So we're including growth manager, or value managers, and core managers in the middle. Importantly, it doesn't have to be sort of the perfect seesaw. I think some people think that the core manager is in the middle, that's the fulcrum. Then you got a growth manager, a value manager, and you call it a day. Well, if that growth manager is quality growth and that deep value and that manager and value is super deep value, it's not balanced necessarily. So, so you spend a lot of time at the aggregate characteristics of a portfolio to deliver what you want. And one benefit I think Acuitas tries to offer is since we offer products to large clients, we offer them also in a retail format, but we're trying to deliver that, that core product with a focus on excess return so that the client doesn't have to think about style, but we can customize it for the client.
When you have, a multi-manager type product, there could be some potential overlap. So how do you think about diversification, when it comes to both their process, the way they look for companies versus, holdings, any type of overlap in holdings?
Yeah, it is occasional that we get an overlap in holdings, and sometimes it's not a bad thing. There's actually a positive signal. There was a famous restaurant chain where a growth manager had owned it and just purchased it. It was sort of coming out of value, starting to get more expensive, executing on its plan, good management team, and the value manager was getting very close to selling it. Growth manager had purchased it. The company was taken out at a 40% premium by private equity. And it was like they weren't the only ones that saw this confluence of events of like this cheap stock was executing and have good management team, et cetera, and both rewarded for it. So it isn't always necessarily a negative, but that said, we tend to have managers in unique places that don't overlap. So we don't have two quality growth managers in a portfolio. We don't have two, you know, very deep value managers. Their disciplines tend to lead them to different stocks, but if there's occasional overlap of a stock, it's not necessarily a negative signal.
What about, I know you touched upon it a little bit in terms of idea generation. What does that look like at, both the manager and I don't know,
Yeah.
I don't know if you could speak for them in terms of, the types of companies they're looking for.
Yeah, for sure. Well, idea generation, I mean, for us, I want to sort of there's kind of two parts of it. One is, us finding investment managers, and the other is the manager's idea generation of the securities that they allocate to. So I'll just give 2 seconds on us finding managers. We try to leave no stone unturned. And that means, searching far and wide for investment managers that have skill and speaking to them in their earliest days. One thing we take a lot of pride on is speaking to investment managers before they're necessarily institutionally ready. It means sometimes they don't think they're ready to talk to the larger institutions, and we think they're ready. They've been managing institutional assets for 20 years, but they started a new firm, and they don't have 500 million in assets and a 3-year track record. Well, we don't mind being the first investor in a strategy. We're not sourcing and seeding firms, but we are doing a lot of work early on with the strategies. So we get managers from reputation and referrals, identifying candidates in some cases in the past successfully before they went to market with their products, because we know the industry. People are setting up firms. A great small cap manager that's starting a new firm thinking about a microcap product or something like that. We talked about a concentrated product. Obviously monitoring the industry, there are databases of managers, but we think that's literally just a sliver of the managers that we need to allocate to. So we want to find the great buyers of those stocks. I personally don't care if they're in a long short manager and we're just talking to them about their longs and a concentrated product for us. And that's what we need to do and think creatively about. Because they may not have the product packaged. We can work through the packaging issue. We just want to find the great pickers of those stocks. So, you have to be proactive to do this and have resources to do it. I think that's part of our competitive advantage. And then it comes to, and I'll pause there, but I'm glad to go into a little bit of sort of the managers and their disciplines on picking stocks.
So I do want to ask about just, U.S. microcaps right now. How do you define the opportunity set? And I guess what inefficiencies do you believe active managers are best positioned to exploit?
Yeah. US Microcap, as an example, which is our flagship in the majority of assets at our firm. We also manage small cap in a number of constructs, but the microcap opportunity is really, to us, the greatest active opportunity in US equity markets. If you are a stock picker and you want to find sort of an information advantage about a name, going down the cap spectrum is paramount. It's challenging to get an extra iota of information when you're sitting at the back of an analyst day of a large cap meeting with 300 other analysts. Whereas, if you're speaking to a company about how they plan to execute going forward, and you're walking through the manufacturing facility of a small company, you're going to catch on pretty quickly, and you may be the only analyst that's actually looking at that name. The opportunity set we benchmark generally versus the Russell Microcap Index, which is really the lower end of small. It's kind of the stocks that small cap managers make their name on. If you look at when we started, we ran this analysis of where does the alpha come from for small cap managers. And for some of them, it was, look, 80% of your alpha has come from names under $500-600 million in market cap. Those are the names that are really generating the strongest returns for you. What if that's all we want? Would you be willing to manage a portfolio of concentrated names for us? And these could be multi-year conversations sometimes, but that's how it started. So the opportunity set, like I said, the Russell 2000, as the 10 seconds on the Russell Index, they basically just line them up by market cap. The Russell 3000 is the largest 3,000 stocks by market cap. The Russell 1000 is the biggest, and the next 2000 is the Russell 2000. The microcap index is the bottom 1,000 of the Russell 2 and another 1,000 stocks. And then stocks get thrown out for various reasons by, low dollar price or other metrics. But it's, generally 1,500 to 1,700 securities, a pretty robust environment of stocks that managers are trafficking in and that some small cap managers own. The challenge is with small cap assets, especially with a larger product, they can't buy down into the smaller names and they limit the opportunity set. So by allocating to a microcap, you're really kind of getting the best of small cap in a lot of ways. The names that small cap managers don't buy anymore because they're running too much money. And so that's a little bit just to kind of frame, where it is and what it is. And a reconstitution, $600 or $700 million in market cap. And it's obviously been climbing up over the years, which is always hard to believe, but but there we are.
How do you fundamentally assess sub-manager holdings, right? Microcaps are often unprofitable, which makes valuation difficult. Do you care about the aggregate multiples of these sub-managed funds, and how do you approach that?
We do. And actually, we think there's a return advantage. It's interesting because there are more names way down the cap spectrum that are sort of unprofitable. I mean, we call them junkier stocks. That doesn't mean there aren't names that can generate a profit. And it can be really powerful when they're at that inflection point of about to make money. But as far as the unprofitable stocks, managers, the short answer is, managers tend to underown them. And we tend to own a lot less of them. And in 2025, that hurts. As you know, Michael, the looking at the market, that was a very low quality environment. And those environments don't tend to last very long. But they're really challenging for most active managers that buy quality and quality metrics. So higher ROE, higher ROA, lower levels of debt. Those are things that didn't pay. And when you saw an environment like the end of the year, with biotechs running, which a lot of active managers view as kind of a very binary event, then you'll see a very small portion of the active management universe leading. So one interesting thing about small and microcap is there's a benefit to just not owning the junk. If we ran an analysis years ago on this and sort of throwing out the negative earners, there's a greater benefit down the cap spectrum than there is up the cap spectrum. And it kind of makes intuitive sense. If you're a large industrial company and you want to build a plant, well, you borrow money and to build it because you have access to capital markets, and so you have more debt on the balance sheet, et cetera. If you're a smaller microcap company, debt may take you it may sort of limit, your ability to do things in the future. It may take you closer to bankruptcy. It's more of a challenging signal if you don't have earnings, if you have higher levels of debt. And so that quality component down the cap spectrum actually leads to greater returns over time. So managers tend to underown it, but not to say they, completely avoid it.
I want to talk about another part. I guess it's almost an extension of that question in terms of avoiding risk. Can you kind of walk us through how risk is defined and managed in the portfolio?
Yeah. We monitor a really large number of factors in the portfolio as far as characteristics of the managers. And so that'll be, valuation metrics. Our simple profile will have all of the stocks in the portfolio, the aggregate of the portfolio. It'll have, the market cap and the sectors and the basic things like that, but also, valuation metrics and valuation metrics by quintile and analyst coverage and beta and all the other things that you would imagine. We actually, in some ways, embrace risk for the underlying managers. We want more concentrated products generally because we can balance some of those things in a multi-manager portfolio, reduce risk in the aggregate level, but accept it and seek it out at the manager level. So this doesn't generally mean, 8 stocks or 10 stocks or something, but for institutional asset managers in the long only space, running 30 to 40 names for some managers is very concentrated. We have others that run 15 to 20, but it's not the more typical 80 to 120 of standard portfolios. And then when it comes to, risk, one important thing is we're not trying to risk control these portfolios massively by reducing tracking error and targeting a tracking error like maybe a quantitative manager may do. And we use and evaluate quantitative managers and think they can be very successful. But importantly, the products are alpha focused. They're focused on generating powerful returns and excess returns over a market cycle. So that means letting out the sales a bit. And down the cap spectrum, in our view, that's where you get rewarded for it. You get rewarded for taking active risk. So while we monitor it closely, have tracking error and alpha targets, and live access to every name in the portfolio, so the transparency is outstanding. We're not trying to massively risk control these portfolios so that they're taking low levels of bets and can't outperform.
And when we have equity managers on, one of the biggest questions we ask is, what is your sell discipline? And so from a manager standpoint, how can you evaluate how their process is working? Is there something that tells you, when you need to make a change?
Yeah, this is one of those answers where it's like, boy, how much time do we have? And I'll give you the short version, which is I think what you shouldn't do is what most plan sponsors and a lot of consultants embrace, and that's looking at the managers that underperformed and just seeking a replacement. Put them on watch after a year of underperformance. Second year of underperformance, it gets really hard to defend. Third year of underperformance, if that's the case, it's over. And I think there's a lot of thinking like that, and it appears very active, but is often a bad decision if it's actually a very skilled investment manager. We've seen some great investment managers go under because they hit a rough patch. And then others over time that we stuck with or allocated additional assets to that have just been sort of, industry beating. So the sell discipline, there are a couple of things, I would note about that. We try to evaluate the manager initially, what kind of manager they are and the environments that they'll do well in and where they won't do well. And one of the most kind of damning things for a manager that would concern us is an environment that favors them where they didn't do well. You have the growth manager that gets their environment and whatever it is, 2003, 2007, doesn't perform in that environment, makes stock mistakes, gets things wrong at a fundamental level. And everybody makes mistakes. It's the kind of industry where you can win just barely the majority of the time and do well. But we look down into the securities, try to see if the manager is making a preponderance of stock mistakes. One thing for us actually that drives the sell discipline is we're very focused on capacity. So capacity in small and microcap obviously is very important because managers that have lower levels of assets are better able to implement their strategies. And assets impede performance over time. So when investment managers start managing larger pools of assets, there are stocks they can't buy, and there are stocks they get slower in as far as their ability to trade them. So we're generally, as they're approaching capacity, we're looking to move on generally. Now, we have not been in, as Michael, a small cap cycle for a long time, right? We're in a very extended large cap leadership cycle. And so we've had more runway with managers because money has not poured into small cap managers and micro cap managers. But that said, we're very attuned to their capacity, where they are, and that's one thing that'll cause us to move on. There's the bigger things like portfolio manager leaves, or something happens at the firm, or they lose large clients, and there's struggling. Those things happen, and small and micro cap, managers are very dynamic. This happens in large cap too. People leave firms, but at smaller companies where individuals might matter more because they have fewer people focused on it, we're very attuned to the people that are leading the process and how much money that they're managing in it, and any changes to the discipline.
I want to take a step back and talk about some of the macro catalysts you might see. So are you excited about microcaps for 2026? Do you see any catalysts on the horizon for the asset class broadly that might, propel it to leadership after kind of a long stretch of not great
Yeah.
performance?
I think the short answer is yes. That it was interesting. That you're getting these signals of sort of the manic condition, and it's clear that there is this upheaval in the market. You're seeing it. I mean, yesterday and today are good examples of, you're seeing it in all sorts of asset classes, including small cap, which tends to be, and micro cap, which tend to be kind of the tip of the whip when it comes to equities, right? If they're shooting up, usually you get a little bit bigger from small cap in short periods of time, like 2021, or a market recovery like after the great financial crisis in 2008 and in 2009. When you get this aggressive rebound shortly thereafter, small and micro cap tends to lead it. There are some bigger picture things with small and micro cap that I think are really positive. And a lot of people have been focused on them for some time. This year, I think the difference is the earnings story that you mentioned earlier, that we have, cheaper valuations down the cap spectrum in micro cap and then small cap. No question, relative to large cap, that it's cheaper and hasn't seen the flows. It doesn't take much to move the needle. You've got entire indices that could fit inside the largest stocks. And so the amount of money that needs to move, we saw this, I feel like a little bit last year with Europe. If people don't realize the scale of, the entire, the European market relative to some of the largest cap names in the US, it doesn't take much to move those names significantly. Saw that in international small cap last year pretty dramatically. But macro catalysts, I mean, just to name some, I think, valuations matter, and that's actually kind of a catalyst. You've got lower levels of regulation for some of these companies, leading to more potential for M&A, which is a potentially powerful catalyst. You've got, the tax rates, having lower tax rates actually, I think, benefits the smaller companies more because they tend to pay, the full tax rate, as opposed to larger cap companies that can maneuver them a bit more. And then really the most important one is come back to the earnings story, which is just, a year and a half ago, it was not the case that 2026 you had higher expected growth for small cap and micro cap companies. And that's the case. So yes, we'll see volatility around it. But at the same time, I think the environment is really well set up for a small cap resurgence.
Yeah. And you mentioned M&A, and that's one of the things I've been kind of excited about with small caps. But I think over the longer term, what I've been noticing is a really slow flow of IPOs into the small cap cages over the past few years. That picked up a little bit in 2025. But
Yeah.
are you seeing that change the dynamic of microcaps at all? Just not having this flow of early stage growth companies that they had, in prior cycles?
Yeah, there is some of that. There are still, and we constantly ask our managers, are you seeing, we had a manager in yesterday that was a microcap manager in the dividend growth space. And this is a subset of, of microcap, right? So always concerned about what is the size of the pool. Is it shrinking so much that it limits your ability to allocate? And they were like, not at all. Absolutely not. There's still, we've had 500 names in our space that qualify for the kind of characteristics that we're looking for. We still do. The same thing goes in microcap and in small cap, that managers are still like, we still have thousands of names to look through. It isn't the case that we, you know, are running out of ideas. The IPO market, yes, it'd be great if it was more robust. There's no question that headlines focus on names that are jumping right over small and micro cap. But it also ignores there are names that come down into small and micro cap because they trip and stumble, and then they're cheaper valuations and people can buy them suddenly. Household names that you can purchase in the small and micro cap markets. And that happens all the time. So there are growth engines. They go public through hosts of ways. It can be, through IPOs, reverse roll-ups, spin-offs, acquisitions, all sorts of characteristics. We'd like to see a more robust IPO market and more names in the space, but at the same time, some of those names tend to be frothier and less enticing for our managers. They're not as active in trying to chase IPOs. But we continue to want to see, a healthy environment for them.
And kind of dovetailing that a little bit with what's going on in private equity and private credit, are you concerned about any possible bubbles in those spaces?
Yeah, and I have to say, I'm not the one qualified to to weigh on this. Asking the public markets guy about private equity. Obviously, it's a battle for us because so much attention and eyeballs have gone to private markets. I feel like there's too much money chasing too few deals in aggregate. There's a lot of dry powder on the sidelines. It seems like there's a lot of focus on continuation funds, um, on sort of the extension of these opportunities. I talked to an endowment the other day that was talking about, an allocation that they'd had for 20 years. And I asked them how long they originally expected to have it. And they said, well, we thought it'd be 10 or under. Um, and there are some of the challenges that you have in the private markets, I think, are the benefit of the public markets in areas like microcap. You have much more transparency. You have much more liquidity. Um, you don't have the smoothing, which is a disadvantage for some people because it can make returns look smoother for plan sponsors. But for us, the number is the number. It's real and it's actionable, and it's liquid. And so you're seeing folks use public equities as liquidity because they don't have liquidity in their private portfolios. Interestingly, the last thing I'll say about the private versus I have some big picture concerns on my own about the private markets, the froth scale and amount of money chasing similar deals, and think that there could be a reckoning. But I think suffice to say, if you're in them, you want to be in the best ones. Don't necessarily chase. It does concern me when the number of sort of retail products in the alternative space that folks may not understand, that are ways for larger firms to either get liquidity or to seek a new source of funds. I think it's great that individuals have access to unique sources of return. I just want to make sure they understand them and that those are good investments. and so, that's a much longer, probably separate podcast.
No, it'd be definitely interesting to watch what's going to happen. It's one of the things we've been watching on the fund side is all the privates and how that's going to work out. But unfortunately, we need to end here. But this was fun. I enjoyed this. Chris, thank you so much for joining us.
David, thank you. And Michael, thank you as well.
And Mike, as always, thank you for being my co-host.
Yep. Thank you both.
I also want to thank our listeners. If you liked the episode, please subscribe and leave a review. You can also share it. And if you'd like to see more of our research on the terminal, go to BI Fund Go for our fund in active research and BISTOXN Go for equity research. Until our next episode, this is David Cohne with Inside Active.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
This podcast is brought to you by Wise, the smarter way to manage your money internationally. If you're getting a headache from juggling different currencies and different bank accounts in different countries, there's a better way to receive money in the currency you need without the slow transfer times or hidden fees. Meet Wise, the savvy way to handle your money internationally. Hold balances in up to 40 currencies with the mid-market exchange rate on every conversion, whether you're receiving payments from tenants abroad, earning as a digital nomad, or converting dividends from your international investments. The Wise multi-currency account is for you. Be smart. Get Wise. Download the Wise app today or visit wise.com. Terms and conditions apply.
With Bali from iShares, you get access to both monthly income and growth potential in one simple ETF. It's the best of both worlds. Discover Bali, iShares Large Cap Premium Income Active ETF. iShares, the market is yours. Visit www.ishares.com to view a prospectus for investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Risks include principal loss and the use of derivatives, which could increase risks and volatility. Monthly income is not guaranteed. Prepared by BlackRock Investments, LLC.